Welcome back to Ferocious Education. This is Ed. Today I'm going to be talking about AMC. Make sure to drop a like to this video to help the channel grow, subscribe, and notifications on. I'll cover our due diligence updates relating towards the earnings, what is yet to come, their further outlook, and some of the recent kind of news that is happening for this one. If you would like to watch my previous video, you'll find it in the description below, and let's jump right into this one. So AMC here, this one had quite of a struggle in 2020, and one of the companies that are really going on for a short squeeze previously with GME, and almost labeled as a meme stock with different hedge funds, etc. What I want to start here quickly is looking at their fourth quarter and full year 2021 results, or 2020 results, my bad. And right off the bat, you see that they did mention that 78% of their theaters did open earlier on and then had to go back closing again for the second wave. And they do talk about how this past year was very, very difficult, and there was some circumstances that might have reflect on the balance sheets on how it might be a little bit unusual. And so moving on, our most important single point of focus after ensuring a safe and clean environments on our theaters is to strengthening AMC's liquidity profile. Since March of 2020, they raised approximately $2.2 billion of gross cash proceeds from net debt and equity capital, and securing more than $1 billion in concessions from creditors and landlords. And so we're going to move on towards the quarter ending, and we get to see that their cash flow is since 2019 it was positive at the end of the year, and in the same quarter we're looking at in 2020, at the end of 2020 we're looking at $1.3 billion in negative in terms of the free cash flow. In terms of a net loss, in 2019 they weren't actually even profitable on terms of the net loss. They were cutting it close around 149 million. Currently they're sitting at $4.6 billion in loss in the last year. We're gonna cut them some slack though, because it's COVID and a lot of things has happened there. And definitely you see that year over year there has been a massive loss difference. So in terms of net revenue itself, they have around less than 10%. Again, it's different times. COVID has made it really difficult for them, but we need to quietly consider that previously they weren't that much profitable to start with. That's some things to consider. And sometimes as an investor, I'm talking about investor, not trader. I will discuss trading in a second, but investing itself, you need to look at these fundamentals. In terms of the balance sheet, cash, and liquidity, during the first quarter, they drew down approximately $325 million under existing revolving credit facilities. In April, they issued $500 million notes due 2025. And you look into some tax remakes, etc. under the CARES Act, where they gave him $17.4 million. The list goes on. Nothing there significant there. But one of the most important thing is in January. So in January 2021, they updated the ATM product to sell additional 50 million shares of Class A stock, completed the sale of all remaining authorized shares under December 2020, and raising approximately almost $580 million at the end of January, and bringing the total ATM equity raised in 2021 to almost $1 billion. So $870 million before commission and fees. In January 2021, the conversion by holders of all $600 million at 2.95% convertible senior notes are due 2026, and a common stock at a conversion price of $13.51, which resulted in issuance of $44.4 million and an expense by $17.7 million. So we're looking into February 2021 now. Our wholly owned international company here, Audience Cinemas Group Limited, entered a new 140 million pounds and 296 million pounds term loan facility agreements, which provided approximately 411 million of incremental debt capital after pay down of approximately 90 million and 13 million pounds on 19 million pounds and 13 million euros on Odeon revolving line of credit. At the current time, there are theater opening updates as of March 5th, 2021. They are at 25% seating capacity, at a maximum number of 50 people per screen, open in all 13 locations of New York. And you're getting to look as well that there is some updates. For instance, as of March 5th, 2021, they're operating 527 of 589 domestic locations, and approximately 78 of its 356 international locations. And we have here another breakdown in terms of their actual dollar-on-dollar revenues, etc., from year over year, and basically looking into the quarters and the year ending generally. So in terms of the quarters first, you get to see that the total revenues here, mainly in 2019, for instance, revolves around, I would say 2/3 admission, 1/3 food and beverages. And you get to see that that kind of ratio still remains the same in 2020. Last quarter. In 2020 overall versus 2019, that ratio still remains somewhat around the same as well. In terms of their main operating income losses, their biggest expenses there is just normal expenses. It still remains the same. But the major part is that the revenue has substantially been beaten up in 2020 due to the pandemic. Now, of course, this is counting down January, February, and some of taking a quick look at October and November. Not really December, because resurgence of COVID has got them to close down a little. So that gives us a little bit of perspective on how their business operates on the financial perspective. And we're going to move on still further on in terms of the forward-looking statements. And for the forward-looking statements, I would recommend that you go ahead and read it. So basically it says, if attendance levels increase consistent with our assumptions described below, we currently estimate that our existing cash and cash equivalents net proceeds from the completed issuance of debt and the common stock in January 2021 and borrowing under the Odeon term loan facility will be sufficient to comply with minimum liquidity requirements under debt covenants, fund operations, and satisfy obligations, including cash outflow for increased rents and planned capital expenditures, all through March 31st, 2022. This requires that we achieve a significant increase in attendance level beginning the third quarter of 2021 and ultimately reach approximately 90% of pre-COVID-19 attendance by the fourth quarter of 2021 and through the first quarter of 2022. As vaccine rollouts continue and more Hollywood production is released in our theaters. If we're unable to achieve this normalized levels of attendance and opening revenues as described above, we may require to obtain additional liquidity. If such additional liquidity were not realized and insufficient, we likely would seek an in-court and out-of-court restructuring of our abilities. That could be, for instance, some sort of bankruptcy. In the event of such future liquidation or bankruptcy proceedings, holders of common stock and other securities would likely suffer a total loss of their investments. So this comes into more if you're investing into this. They have some ambition goals. For instance, by the third quarter, they're looking to have all their theaters up at 90% COVID-19 level attendance. And in fourth quarter, they need to have it fourth quarter 2021 and first quarter 2022, they wanted to go 100%. Now it comes to the question too, the pandemic has done something that a lot of people, I guess for this company, are not realizing. The rise of Netflix subscription, the rise of Disney Plus, the rise of even Amazon Prime Videos, Fubo, all these different things are trying to get a piece of the pie. And they don't, I guess, realize that times might be a little bit different and they need to do some kind of substantial differences. Now their capital are tied and there's a lot of debt in there. And so there might be a bit of question on how they're going to do it. It's going to be very, very interesting. Again, I know I'm giving a lot of information. This is meme stock at this point based on a lot of people, but I like to give you a balanced thing if you're looking towards investing or even to trading and thinking, well, what's happening? And a big part of this one here is this chart. This is actually from their own SEC filing. And it shows the SP 500 levels, the peer groups, and AMC. And what you get to see is that industry itself in terms of the peer groups has substantially not seen as substantial gains as SP 500. SP 500 here has been showing that, hey, it's actually climbing. It's been giving good returns. Meanwhile, AMC here, this is the square ones, have been really not seeing that well of returns, including as well compared to their peers. See, the peers, yes, it's lower, but for instance, in 2019, in September, their peers were level at 100. They were around half of that, at 50. That's something to consider, right? Their peers and them, there is different returns, and you need to consider that if you're investing for a longer term. Of course, a lot of bigger part of this kind of market currently is that fundamentals are trash, but I would like to still consider if you're investing. I'll discuss trading and technical analysis part. Now, in terms of their issuance of shares, they're looking to have from 500 million shares to 1.024 billion shares, and that's on the meeting held on May 4th. And so there's going to be a vote there. This is probably going to be a safety net for them towards paying off their debt, or if the price continues to squeeze, I don't see why they wouldn't go ahead with more at the market offerings. In terms of the market cap, they're currently at $4 billion. If we were to go to statistics, you're seeing the price over sales is 3, which is still comparable, and that's a good thing nonetheless. This is based on trailing 12 months, so keep that in mind. In terms of financials, what we're seeing here on the balance sheet, on the quarterly perspective, in the last quarter, their total assets somewhere around $10.2 billion, and you're looking at a total debt. It's actually not showing the total debt, but that's at least a total. Yeah, there you go, $96 million. Now there is leases, etc. So I guess assets towards debt. You see the massive payoff of debt. Take a look at that. From $11.4 billion, it goes down to $96 million. Of course, there's still notes, etc. There's been a lot of conversions, but definitely this squeeze that we did with GME and this one here trailing with definitely has seen this one a good substantial amount of total debt reduction. And one last thing before going on towards the technical analysis, the short float seems to be at 20%, so a short squeeze that would fly this one might not be as realistic as a lot of people hope because the shorts have covered substantially. Yes, there is 20% short float still, so that's something that a lot of people are counting on. Relative volume has been dying, but this one has seen 10% today, even though the relative volume is around 70%. Some companies have been giving this one a price target of $251 on average. You're looking, for instance, into MKM Partners, putting in a sell at $1. Currently, the price point is $11.16, and let's just now on towards the technical analysis. If you haven't done so, please make sure to subscribe and leave notifications on. It helps my channel a lot. And if you'd like to join our Discord to have a bit of more discussions and talk about this more, feel free to so. It's in the description below. It's free. So on a 1 week perspective, the most important thing that I want to look at this here is that the ADX shows in still this really massive trend at 35 or 39.58, close to up to 40. That suggests a very, very strong trend. Next up, what we're seeing is that momentum is sitting at 841. That's a really bullish thing. MACD is increasing, and that's really bullish. And the willing percent R is sitting at neutral. It's not even overbought there. On a 1 day perspective, things are looking interesting. Momentum is at 2. That's a good thing. ADX shows in the potential for a strong run. It doesn't signify that trend as strong as the 1 week perspective. And in terms of willing percent R, it's on the corner of overbought, but the MACD shows a really bullish action. Moving averages are all bullish. The 10 SMA is above the 30 EMA, and this is the trading action zone between 938 and 795. If it does fall within there, as you see here, it does bounce back quite nicely, and that's a bullish thing that we're seeing, is that you have this kind of safety net underneath. 50 SMA is above the 200 SMA, and these things are amazing. Now, in terms of the moving average band, it hasn't been following it, so I'll disregard that. Stochastic fast and stochastic slow are both showing that there is a potential for another leg up. Just be careful. In terms of Fibonacci retracements, things get a lot more interesting. You see Fibonacci retracement levels. The support level sits at 894, 624, and 191. Now, in terms of significant resistances, 1112 is actually the current support. Look at that. It just became a support, even though it was a very strong resistance. And then the current first resistance is at 1330, 1640, and 2036. Coming on towards, let's say, doing just price line actions. And we're seeing a significant support currently is lying at the 1102 level. It's a very important one that we just broke today. 1018. And then below there, you're looking at 934. And then 766, looking at 614, 539, and 356. Significant resistances. You're looking at 1155, and then next 1206, 1326, 1434, and then up to 1664. Comes to the question to Ed, what do you think? Well, if you're investing in this one, this might be a little bit tricky. They really need to up their game in terms of streaming services. Perhaps that's a lot of most important ways to go, or they need to restructure and find a way to improve that. Now, I do suspect once things get back to normal, that a lot of people would want to go to watch the movies, at least in the start, but I don't think that it will go towards a place where it was in 2017 at 3565 in terms of attendance level. Between 2017 and 2020, or at least 2021 right now, Amazon, Disney, Netflix up their game on streaming services, and they're a game changer right now. And so you need to consider that, and I'd like to see the management's plan towards these kind of things coming up. But in terms of taking a look into investments, perhaps a more realistic view would be the 20-ish range, where you're looking at 2018, perhaps 2019, so within this range. But generally, if you were to look at it from a longer-term perspective, things weren't looking that well if we were to draw a trend line before even the pandemic. So take a look at that. it's still having that trend line. I think the part where it started seeing a bit of results was when it became meme stock, so you can definitely trade it for perhaps further on into 20, squeezing in, etc. But in terms of an investment, be careful onto this one because you might get burnt if it does drop significantly, and I doubt it was going to drop significantly anytime soon, but still, play the hype and be careful. Don't go all in. What do you think about this ticker? Make sure to mention down in the comments below. Share, subscribe, and like it.